All right, today we are diving deep into a really critical earnings call from Moody's. Now, this is a company that was facing a huge storm of fear over AI, and the big question on everyone's mind was, is their entire business about to get disrupted? So, let's dig in and see exactly how they fought back.
Well, the market's reaction, it was immediate, and it was loud. A massive stock jump of over 6.5% in a single day. You just don't see a move that big unless something fundamental changes. It tells you the call didn't just report numbers, it completely changed the narrative. So what on earth did investors hear that got them so excited? Here's how we're going to break it all down. First, we'll look at the results, which were just a clean beat and laid the foundation for everything else. Then we'll get into that AI overhang. You know, the anxiety that was really dragging the stock down. After that, we'll unpack management's killer defense, what they're calling their AI moat. Then, of course, we'll look at their guidance for the future before we put it all together with our final rating. Okay, so first things first, the numbers. Look, before you can win a battle over your company's story, you've got to put the points on the board. You have to deliver strong results. And on that front, Moody's, well, they absolutely delivered. I mean, it was just a clean sweep, a beat right across the board. Adjusted earnings per share came in at $3.64, which was way ahead of what anyone was expecting. Revenue also topped estimates, hitting $1.89 billion. But what's really impressive, what gets me excited, is the strength in both of their main divisions. You had a massive 17% jump in their ratings business, that's Moody's Investor Service, and a really solid 9% growth in their data and analytics arm. Just strong all around. And you know, this wasn't one of those little beats where they just squeaked by. Not at all. As you can see, they blew past the high end of Wall Street's expectations by over 20 cents. That is a significant 6% surprise. An outperformance like that, it really makes people sit up and listen. It gives management the credibility they need to tackle those bigger, tougher, more strategic questions. But here's the thing. Even with those fantastic numbers, the company came into this earnings call under this big, dark cloud. The market wasn't really worried about the last quarter. It was worried about the next 10 years and this looming perceived threat of artificial intelligence. And this really gets to the heart of the whole conflict, right? The fear was that generative AI could just come in and replace Moody's core business, that it would turn credit analysis into a cheap commodity. And this wasn't just some abstract theory. It had a very real, very painful impact. The stock had been absolutely hammered, falling over 17% this year alone before the report. The pressure was on, big time. So this really became the central question of the entire call. I mean, the market is clearly pricing in this huge disruption risk. So what do you do? How does CEO Rob Fauber and his team address the elephant in the room? They knew they had to hit this thing head on. And their response was brilliant. They went on the offensive. They completely flipped the script on the AI threat, arguing that it wasn't a risk at all, but actually a core competitive advantage. They laid out this incredibly detailed case for what they started calling their AI moat. This quote right from the CEO, it just hits the nail on the head. The argument is actually pretty simple. Large language models, they train on the public internet, but Moody's value? It's built on a fortress of private, proprietary data that's been curated for decades and is all locked down by these complex legal agreements. It's information an AI can't just go out and scrape from a website. And this moat? It's not just one thing. It's built with all these different layers of defense. It starts with the data, of course, which is protected by this web of intellectual property rights, but it's also about how their tools are already so deeply embedded in their customers' daily work, which makes them incredibly sticky and hard to replace. And maybe, just maybe, the most important piece is the reputation for providing trusted, decision-grade analysis. I mean, that's stuff that is auditable and defensible, which is an absolute must-have for their clients in these heavily regulated industries. And then they totally flipped the script. Management basically said, AI isn't a threat to us, it's a massive business driver. And this number, over $70 billion, well, that's the value of AI-related bonds Moody's rated in just the fourth quarter alone. This is the money being raised by tech giants to build the AI infrastructure of the future. So it proves that Moody's is a key enabler of the AI boom, not its victim. What a comeback. Okay, so defending their business model was one thing, but management knew they had to back it all up with a really confident outlook for the future. I mean, a great story is one thing, but investors, they need to see the numbers. And right here, you can see exactly why the stock popped so hard.
The guidance for 2026 was just incredibly strong. Their earnings forecast is actually above what Wall Street was expecting. They're projecting significant margin expansion, guiding to incredibly powerful free cash flow, and then backing it all up with a massive $2 billion share buyback plan. This is pretty much the definition of a confident forecast.
So when you put it all together, the strong quarter, that really compelling defense against the whole AI threat, and the super bullish guidance, what does it all mean for the stock going forward? Well, it's time for our rating.
Okay, so based on management's really successful reset of the narrative and that strong fundamental outlook, we are initiating our rating on Moody's as outperform.
Our thinking here rests on three key pillars. First, management just flat out neutralized the market's biggest fear. They turned the AI risk into a credible competitive moat. Second, their 2026 guidance gives you a really clear path to strong earnings growth and higher profitability. And third, that super aggressive $2 billion buyback, that provides a powerful floor under the stock. They controlled the story and then they backed it up with the numbers. Textbook. And as always, just a final reminder, this analysis is for informational purposes only. This is not financial advice.